There's a check on gov.uk that takes less than 5 minutes. And for many people in their 50s and 60s, it reveals a number that could quietly cost them thousands of pounds in retirement. A number that, with a small amount of effort right now, they can still do something about. It's called your national insurance record, and the number to look at is your qualifying years. For the full new state pension, currently worth £12,547.60 a year, you need 35 qualifying years on your national insurance record. To get any state pension at all, you need a minimum of 10. If you're short of 35, even by 1, 2, or 3 years, your state pension is going to be smaller than the full amount for every week of the rest of your life. Each missing year reduces it by about £358 a year. Over a 20-year retirement, just one missing year of national insurance costs you around £7,000. 5 missing years, which is genuinely common for people who took time out to raise children, or to care for a parent, or to work abroad, or who were self-employed at certain points, costs you over £35,000 in lifetime state pension. 5 minutes on gov.uk reveals exactly where you stand. Stay with me, because 2 things decide whether you can still do something about the gaps. The first is a free credit that grandparents specifically are missing in their tens of thousands. A credit that can be backdated all the way to 2011 and that doesn't cost a penny to claim. The second is the maths of whether to actually pay to fill remaining gaps with voluntary contributions. And the answer is more reassuring than most people think. For a healthy person of reasonable life expectancy, the break-even comes in less than 3 years of receiving state pension. After that, it's pure profit for the rest of your life. Let me explain. Okay, the basics, then we'll do the check. Then we'll talk about what to do with what you find. The new state pension applies to anyone reaching state pension age on or after the 6th of April 2016. State pension age is currently 66, rising to 67 between April 2026 and April 2028. The full new state pension in 2026/27 is £241.30 a week. That's a touch over £12,500 a year for the rest of your life, paid every 4 weeks, and rising each April with a triple lock, the highest of inflation, wage growth, or 2.5%. To get the full amount, you need 35 qualifying years of national insurance contributions on your record. What's a qualifying year? It's a tax year running from the 6th of April to the 5th of April, in which you either earned enough to pay national insurance or were credited with national insurance contributions through certain benefits or activities. You're paying national insurance automatically if you're employed and earning over the lower earnings limit, which was £6,500 in 2025/26, or if you're self-employed and your profits are above the small profits threshold. You're getting free national insurance credits if you're receiving universal credit, job seekers allowance, employment and support allowance, carers allowance, child benefit for a child under 12, or even just sitting on jury service for a few weeks. So most full years of work or full-time caring while receiving the right benefit tick the box. But here's where the gaps creep in. If you took a few years out for full-time childcare, even with child benefit covering some of those years, there may be gaps after your youngest turned 12. If you worked part-time at very low pay, below the lower earnings limit, those years didn't count towards a qualifying year. If you spent any years working abroad without paying voluntary contributions back into the UK system, those are gaps. If you were self-employed with profits below the small profits threshold and didn't pay Class 2 voluntarily, those are gaps. If you had a few years of long-term illness where you didn't claim employment and support allowance, gaps. The list is long, and most people who have gaps don't realize they do because nothing tells you. There's no letter, there's no warning. The number just quietly sits on your record, and the only way to know is to look. Right. So how do you look? This is the 5-minute check. Go to gov.uk and search for Check Your State Pension Forecast. That's the official tool. You'll need to log in with your Government Gateway ID or sign up for one if you don't have it. For that, you'll need your national insurance number and a few identification documents to hand. Once you're in, you'll see three things. 1. Your full national insurance record, every tax year since you turned 16, marked as either full year, year is not full, or no contributions. This is where the gaps are revealed. 2. Your state pension forecast, how much you've already built up and how much you're projected to get if you carry on working until state pension age. 3. A facility to look at each gap year individually and see how much it would cost to fill it with voluntary contributions. That's it. 5 minutes. The most important 5 minutes you can spend on your own retirement. Now, here's where a lot of people in their 50s and 60s panic. They see year is not full against years from the 1980s or 1990s, and they think they have to fill them all. They don't. Most of those old gaps no longer matter. There's a 6-year rolling rule, and after that, the gap is closed forever. Under current rules, you can only fill gaps from the last 6 tax years. So as of the 2026/27 tax year, that means you can pay voluntary contributions for gaps going back to the 2020/21 tax year. Anything older than that, under the standard rules, you can't fill anymore. There was a special transitional window that ended on the 5th of April 2025, which let people fill gaps going back to 2006. That window has now closed for most people. The standard 6-year rule applies across the board. There's a deadline coming up that's worth marking on your calendar. The 2020/21 tax year E, that's the oldest year you can still fill right now, falls out of the 6-year window on the 5th of April 2027, less than a year from this video. So if you have a gap in 2020/21 that's worth filling, this is the window to do it. Now, should you actually pay to fill those gaps? That's the second open loop I planted. The maths. A voluntary Class 3 contribution for the current 2026/27 tax year costs £17.45 a week, or £907.40 for a full year. When you fill an older gap year, you usually pay the rate that applied at that time, which can be slightly cheaper. In return, each filled gap year converts a not full year into a qualifying year. That adds approximately 1/35 of the full state pension to your future entitlement. 1/35 of £241. 30 is £6.89 a week, £358 a year. Now, do the maths. You pay around £900 today. You get £358 a year for the rest of your life, starting at state pension age. Break-even is just over 2.5 years. If you live for 10 years after state pension age, well below average UK life expectancy, that one filled year is worth roughly £2,500. If you live for 20 years after state pension age, close to the average for someone reaching 66 in good health today, that one filled year is worth around £7,000, net of what you paid in. And of course, every other filled year adds another £7,000 over the same retirement. 5 filled years could be worth £35,000 of extra pension income. That is one of the highest return decisions almost anyone with gaps can make, provided, that is, the gaps are actually worth filling for you specifically. Which brings me to the warning. Voluntary contributions don't always increase your state pension. There are a few situations where paying would be a waste of money. If you were contracted out of SERPs or the state second pension before 2016, common for people in public sector pension schemes or large workplace schemes, you may have what's called a contracted out pension equivalent, or COPE, that effectively reduces your new state pension entitlement. In some cases, you can have 35 qualifying years and still not be entitled to the full new state pension. Extra contributions on top of those years won't help. If you're already on track for the full new state pension through normal future working years, you don't need to fill old gaps. The system caps your pension at the full amount, so paying past it does nothing. If you're heading into retirement on a very low income and are likely to receive pension credit anyway, every extra pound of state pension you generate reduces your pension credit by approximately £1. You might pay £900 out of pocket for no net gain in income. And if you're seriously unwell with a short life expectancy, you may not live long enough to break even. So before paying anything, there is one absolutely essential phone call to make. Call the Future Pension Center if you are under state pension age. The number is 0800-731-0175. If you're already over state pension age, call the Pension Service instead, 0800-731-0469. Tell them what gaps you have. Tell them your situation. They will calculate on the phone with you exactly how much each filled year would actually add to your state pension. They will tell you whether filling is worth it for you specifically. This call is absolutely free. It can save you from making a £900 mistake on each gap year you might otherwise have filled needlessly. Only after that call should you make payment. Payments are arranged by contacting the National Insurance Contributions Office on 0300 200 3500. Now, the first open loop I planted at the start, the free credit that grandparents are missing. It's called Specified Adult Child Care Credits. If you have ever looked after a grandchild, or a niece, nephew, or other young relative while their parent worked, you may be entitled to free national insurance credits for that time, and those credits can be backdated all the way to the tax year 2011/12. Read that again. Backdated to 2011. Some grandparents are sitting on as many as 14 years of credits they never claimed. The rule is straightforward. When child benefit is being claimed for a child under 12, national insurance credits go automatically to the person who claims the child benefit, usually the parent. But if that parent is already working and paying national insurance through their job, they are getting their qualifying year anyway. The credits attached to the child benefit are surplus to them. Those surplus credits can be transferred to a family member who actually did the child care and who may have gaps in their own NI record. Grandparents who looked after grandchildren during the working week while parents commuted into the office. That's the textbook case. To claim, you need a form from gov.uk. Search for Specified Adult Childcare Credits. You fill it in, the working parent signs to confirm they're transferring their unused credits, and HMRC adds those credits to your record. This is one of the most underclaimed national insurance credits in the entire system. Hundreds of thousands of grandparents are entitled to free qualifying years they've never collected. If that's you or your parents, apply. A quick mention of other free credits, because many people don't realize they could have been claiming without paying. Carer's credit. If you provided 20 or more hours of care a week, which we covered in video 3, credits from Universal Credit, Job Seekers Allowance, Employment and Support Allowance, and Maternity Allowance, all granted automatically while you're claiming the benefit. Credits while doing jury service. If you can backfill gaps with free credits before paying anything, do that first. One quick protection before we finish, because national insurance scams are now common. The real HMRC will never call you out of the blue offering you missing state pension money or asking you to pay for credit assessment. They will not text you links to claim extra state pension. Genuine payments for voluntary contributions are made by you to HMRC after you have decided. They are not offered to you. If you get a suspicious call or message, hang up, delete it, and forward suspicious texts to 7726. Forward suspicious emails to phishing@hmrc.gov.uk. So, 2 things to do this week. First, do the 5-minute check. Go to gov.uk, search check your state pension forecast, and look at your record. Even if you're sure you have no gaps, look. Even if you're under 50, look. Because catching a problem in your 50s leaves you the most flexibility to fix it. Catching it at 65 leaves you with very little. Second, forward this video to one person you know who might benefit. A sibling, a parent, a friend who took a few years out for kids or for caring, because the people who lose the most are, again, the ones who don't know to look. This information has to travel. Now, there's one more piece of money that, for many UK pensioners, is sitting with HMRC's name on it, not the DWP, HMRC. If you have a state pension, plus a private pension, plus maybe a bit of savings interest, the chances are reasonable that your tax code is wrong. The way HMRC handles multiple income streams for older people means many pensioners are quietly overpaying tax year after year without knowing. Every summer, HMRC sends out a letter called the P800. It tells you whether you over or underpaid tax for the previous year. Most pensioners who receive one don't read it carefully, and some of them are owed hundreds of pounds in refunds they have never claimed. That's the next video. The HMRC tax code error that's quietly overcharging UK pensioners and how to get the money back. Subscribe so it lands in front of you, because every April these rules change, and the people who stay informed are the ones who don't get left behind. This channel is for general information only. We are not affiliated with HMRC, the DWP, or any government body, and nothing here is personal financial advice. All figures are current at the time of recording and can change, so always confirm your own situation at gov.uk or with a free advisor such as Citizens Advice or Age UK.